there's no way for the world and the US to get out of monetary printing, right? So you have debt that has to be, you basically have to lower interest rates, which makes more money in the system, makes it more free. And you also have to get in a position where the government is going to have to probably stimulate during the next recession. That's the US debt going even higher. The Fed will expand their balance sheet again. That's essentially the debt going even higher. And so you want these physical assets that kind of trade in terms of US dollars. So if there's more dollars, then gold is a place to store your value or keep your value, as it should go up in response. So I'm loving the chart on gold, and I think we're getting ready for that next leg up soon. And I still think we're north of 2,500 by year end.
In the ever-fluctuating world of precious metals, renowned financial analyst Gareth Soloway, president and chief market strategist of inthemoneystocks.com, maintains a bullish outlook on gold and silver. Despite recent market volatility, Soloway anticipates gold reaching $2,500 by year end, citing expectations of continued monetary expansion and increasing government debt as key drivers. As of Monday's American session, gold has resumed its upward trajectory, trading above $2,400 after a brief correction from last week's 7-week high of $2,424. The precious metal's ascent comes as the US dollar retreats, following initial gains sparked by news of an alleged assassination attempt on former US President Donald Trump. However, the week began with a bearish tone for gold, touching an intraday low of $2,405. This dip is primarily attributed to a strengthening US dollar, which gained ground despite growing expectations of a Federal Reserve rate cut in September. Silver, often seen as gold's more volatile cousin, is also experiencing market pressures. The silver price extended losses for the second consecutive day, trading around $30.60 per troy ounce during Monday's early European session. This downturn is partly due to mixed economic data from China, a significant player in global silver demand due to its manufacturing sector. Despite these short-term fluctuations, Soloway remains optimistic about silver's prospects. He believes that while economic weakness might affect industrial demand, increasing desire for wealth protection will drive prices higher. Soloway notes that middle-income investors may find silver more accessible than gold due to its lower price per ounce. Please tune in for our exploration of Gareth Soloway's expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. We appreciate your support.
So what we have here on gold, and gold again had put in a topping tail over here. So we do see that this was a little sell signal after the monster move to the upside. We saw the breakout. Essentially, what this was a 4-year breakout, right? So if we take the high from 2020 and we drag a trend line across, notice how you kept on going up and hitting that line and getting rejected, hitting the line, rejected, hitting the line, rejected. Notice how this was the shallowest pullback because it was the one right before the breakout. Now, once we got up to this high, we kind of stalled out. We've been consolidating since. And consolidation means price digestion. So after a huge move, think about it like this. If you have a marathon runner runs a marathon, they can't just run another marathon right after. They need to rest. They need to refuel by eating. And that's what the chart of gold is doing right now. Now, just in the short term, we saw a little breakout here. My guess is we'll chop around a little bit more and then make a run at the highs. And I actually think we will break out. And I still think we're north of 2,500 by year end. So I continue to be in the camp that, like we talked about just a little while ago, there's no way for the world and the US to get out of monetary printing, right? So you have debt that has to be, you basically have to lower interest rates, which makes more money in the system, makes it more free. And you also have to get in a position where the government is going to have to probably stimulate during the next recession. That's the US debt going even higher. The Fed will expand their balance sheet again. That's essentially the debt going even higher. And so you want these physical assets that kind of trade in terms of US dollars. So if there's more dollars, then gold is a place to store your value or keep your value, as it should go up in response. So I'm loving the chart on gold, and I think we're getting ready for that next leg up soon.
What about silver?
Yeah, silver's an interesting one. It also is performing very well, much like gold, in that it pulled back after its recent run up to $32.50. It's broken up here. I still think it might need to consolidate down a little bit more. See these two lines right here? That's going to be good support around 29.50. But I'm in the camp that even though silver is somewhat an industrial metal, right? So it's used in a lot of production of things. So if the US economy weakens, that does take a little bite away from silver. But I still think the overpowering thought process that more people in the world and in the US are taking on, which is, how do I protect my money against reckless spending and kind of the past decades of reckless spending, if you will, and future spending, it's going to be silver. So if you look at retail investors, people that let's say you don't have, $500,000, people that have a lot of money probably are buying gold. If you have a mid-level amount of money, you're probably looking at silver. It seems cheaper at $31 an ounce. You can buy a few hundred ounces of silver for a reasonable amount of money. That's where you're going to see a lot of the middle income, middle class moving in to protect their wealth. So I do think that you will see silver trade up as well, although it's a little murkier because of the industrial production side. I don't often look at the gold silver ratio, but I will say it is useful at extremes. So at some point you get a big divergence in the gold move versus the silver move. And I do think that does give you an edge in trading and swing trading. But I think for me, when I'm playing the metals and I'm looking at the key levels. So number one, I'm looking at the technical points, the pullback levels, the supports, the resistance levels. But even more so, what just keeps me buying the dips into support is just that macro viewpoint that we know the end game here. And at some point, we're going to have a recession, whether it's this year, next year, or 5 years from now, there will be a point. And if the US government hasn't been able to control their spending during an expansion, which is when they should be paying off their debt, paying off our debt essentially, which is our US national debt, then what are they going to do when we have a bad recession? Well, they're going to go back to their playbook of printing more money, which again just makes me want to be long gold, silver, and the rest of these. But I do think, again, for shorter term moves on disparities, gold and silver ratio absolutely makes sense.
In the ever-evolving landscape of U.S. Treasury yields, 2024 has already witnessed significant shifts that are capturing the attention of investors and analysts alike. The benchmark 10-year Treasury yield, a key indicator of long-term interest rates, has traversed a volatile path in the year's opening months. Starting just below 4% at the beginning of the year, it climbed to a peak of 4.70% by late April before moderating in subsequent weeks. In contrast, short-term rates, represented by 3-month Treasury bills, have remained relatively stable. Gareth Soloway highlights the current 10-year and 2-year Treasury yield inversion as the longest in history. Traditionally a recession indicator, this prolonged inversion has raised concerns. Despite contrarian views, Soloway advises respecting historical patterns, emphasizing their potential significance for the U.S. economic outlook. Adding an unexpected twist to this already complex financial narrative, a shocking incident occurred on Saturday. Former President Donald Trump, currently campaigning for a return to the White House, was reportedly shot. This event has sent ripples through global markets. The Treasury yield curve has steeped, and stock futures have lifted. Let's get back to the interview.
Basically, the yield curve is a precursor to a recession. Historically, it's been basically dead on every single time. You can go back to even before the Great Depression, there was an inversion of the yield curve. And this chart here shows us since 1980. And what we know is that the more prolonged the yield curve inversion, where the 10-year yield is paying out less than the 2-year yield. And that's what the inversion means for those of you out there that may not understand. It's usually when you lock up money for a longer period of time, you demand a higher interest rate because you're locking your money up. You can't do anything with that money for X amount of years. And so, if you're putting your money away for 1 year, you're going to demand a lower interest rate because it'll be freed up in 1 year versus if you're locking your money away for 10 years. And so it's when that gets lopsided, where the 10-year is paying out less than the 1 year or the 2 year in this case, which is what's happening, that's a precursor that something's wrong in the system. And here we can see very clearly that this inversion is now the longest in history below this green trend line, which is the break-even point. And we have seen it, like just before COVID, we quickly had a little inversion and then COVID hit. And obviously we know what happened there. And then over here before 07, 08, it was inverted for a while before obviously we saw what happened in 07, 08, 09. And so the biggest thing to keep in mind here is that when you see an inversion like this, it tells you that a recession is coming. But historically, if you look at this chart, it's not until it uninverts that you actually get the recession. So about a year ago, 2 years ago, when the inversions began, people were always like, oh man, the yield curve is inverted. We're actually going to see a recession any day now. But in reality, it's when it uninverts is the trigger point for that recession. And we haven't seen that yet. So in theory, we probably won't see a recession until the yield curve triggers and goes back above that flat line. But the key is this, is that a yield curve inversion like we have now, every time in history, it has signaled a coming recession. And the key is people say this time is different. I don't go by that methodology. I say that until proven otherwise, you have to go with what history has said to you over and over again. And I think, obviously I wasn't around in the 1920s, but the roaring 20s seem very similar to what we've seen here. You had so much liquidity in the system back then. Loans were being given out. Leverage was being used. The government was spending, et cetera, following, World War I in the early 20s. And so there's a lot of similarities with that period as well. And then you go even up to, before 2008 and 2009 with the loans that were being given out for housing at the time, and people were taking, zero down payment type loans. Very similar to what's going on now. And I think the only thing is we're just seeing it in a greater fashion at this point. There's more intervention by the Fed. I know everyone's talked about how interest rates have gone up, but if you look at the underbelly of the system, the Fed, especially in March of 2023, they started actually having a loan program that was an emergency lending program for banks because banks were starting to fail. We remember Silicon Valley Bank and these other banks. And so the Fed actually had this loan where banks could borrow essentially unlimited amounts of money. And it was called an emergency lending program. And the key was that you didn't have to actually have an emergency to borrow the money. You could just borrow the money essentially for free. So banks were taking that money out and then pumping it into the system to make money off of it and make that spread. And so there's lots of this type of thing that are going on where you have government spending, creating massive liquidity and functional money in the system. We continue to see more and more kind of risk taking. Like if you look at crypto, and I'm a big fan of Bitcoin myself, but crypto itself is a great example of how people are saying, screw the fundamentals. Doesn't matter if there's real value there. If it's going up, I'm going to just jump on board. And that happened in 1928, 1929 before the crash, happened in 1999, 2000, happened in 07 into 08. All of this mentality of this greed of saying, hey, doesn't matter if there's real value. It's all about just getting in because prices will go up. And right now it's working, and it will continue to work until it doesn't. And then things get very nasty when everyone runs for the door at once.
Given the current economic indicators, including the prolonged yield curve inversion and fluctuations in precious metal prices, how do you foresee the interplay between monetary policy, market sentiment, and asset performance shaping the financial landscape in the coming year? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.